Hi, it's Dr. Bear. Today I'm going to be talking about accrual basis accounting versus cash basis accounting. So I'm going to minimize my video screen here so that we can get started on our discussion topic. Okay, I'm going to work through this exercise in just a minute, but first I want to give you a little bit of explanation about accrual basis accounting versus cash basis before we work through this exercise together. Cash basis accounting is when transactions are recorded only when cash changes hands. Now, that does not mean that the business only accepts cash. It's just that they don't record any transactions in their accounting system until either they've received cash from a customer or they've paid cash for an expense. Cash basis accounting is a violation of generally accepted accounting principles. It's not allowed under generally accepted accounting principles, but small private businesses can use cash basis if they qualify under IRS guidelines to do so, because they're not required to follow all of the generally accepted accounting principles to the same level as a public corporation would be. A public corporation, if you've watched some of my other videos, you'll remember is a company that sells stocks and bonds to public investors. They are not allowed to use a cash basis accounting system. They have to use an accrual basis accounting system because cash basis gives you too many ways to hide transactions. You can hide income and revenue. You can hide liabilities for debts that you owe if you're using a cash basis system. So obviously that's not a good scenario for an investor or a creditor to not have access to that type of information when they're trying to make decisions about whether or not they want to invest in a company or loan money to a company. Now, if you are a small private business and you use a cash basis accounting system and you go into a bank and want to borrow money, they may ask you for more financial information related to the things they cannot see from your financial statements because you're using a cash basis system. A cash basis system works fine for a small company. If you think of a company like someone who has a landscaping business and they go out and they do landscaping jobs, and all of their expenses are related to the services they're providing, and putting gas in their machines and those types of things. Using a cash basis system is fine for a company like that. Again, if you go to www.irs.gov, you can read what the guidelines are under the IRS tax code for when you would be allowed to use a cash basis system. If you are keeping inventory, generally you cannot use a cash basis accounting system. You have to use an accrual basis system. So an accrual basis system records transactions when they occur, regardless of when the cash changes hands. So you are going to record revenue on your income statement when you have performed work that you have earned the money, even if the customer hasn't paid you yet. And you are going to record the expenses on the income statement when you owe them, when you incur them, even if you haven't paid them yet. This goes along with the revenue recognition principle that requires companies to record revenue when it has been earned. There are 4 criteria that must be met before revenue has been earned. The first criteria is that there is evidence of an arrangement between the customer and a business. An example of that would be a contract. The second criteria is the price must be fixed or determinable. The third criteria is the business has to be reasonably assured they are going to collect the payment from the customer. But the last criteria is the key. It means that the business has delivered the goods or services to the customer. So if you've met the first 3 criteria, but the customer has not yet received what they paid for, you have not yet earned that revenue. And we're going to talk about that in a second when I show you some adjusting entries when we talk about unearned revenue. There's also the matching principle that basically states expenses are recorded as they are incurred and matched with the revenues that have been earned during the same time period. That's what that matching principle is. You are matching your current expenses with your current activities of earning revenue in the course of your business. So when you're working under an accrual basis accounting system, you're going to have adjusting entries related to the activities of the business because you are recording revenue When it's earned, it hasn't been received yet, and you're recording expenses when incurred that haven't been paid yet. That's going to result in the need to have adjusting entries at the end of the accounting period. So I'm going to talk about that in a minute, show you some examples of what adjusting entries are. So you will have accrual entries and deferral entries. And those are the two types of adjusting entries that you are going to be recording in the books. These have to be done in order for the books to be complete for the period. You have to review the books, review the general ledger, and determine if there is missing information that hasn't been captured in the day-to-day activity of the company. And a lot of that is going to be recorded or is going to be occurring because of the accrual basis system. So 2 easy ways to remember the difference between an accrual and a deferral. An accrual means activity has already happened, but cash has not yet changed hands. So you've incurred an expense or you've earned revenue, but you have not paid the expense yet, or you have not been paid by the customer yet. That's going to result in the need to record accrual entries. Deferral entries means that payment has changed hands, but the activity hasn't happened yet. That's where unearned revenue comes into play. A customer pays you for something they haven't received yet. You have to defer the revenue, so you're going to record it as an unearned revenue. Or if you prepay an expense, for instance, you might pay for your insurance for a year in advance. That is a deferred expense. You're going to record that on your balance sheet as a prepaid expense, and you're deferring that until the time period passes for which the expense was due, and then that prepaid expense gets moved from your balance sheet to your income statement. So we're going to be talking through those things. If you're one of my students and in my classes, we'll be talking about that a little more in depth when we get to the topic of accruals and deferrals and accrual basis accounting. So let's work through this exercise here so you can see the difference between accrual basis and cash basis. And I've tried to zoom into this a little bit so that it's easier to see on my video. So if I look at the first transaction, it tells me I sold widgets to my customers for $10,000. I received $7,000 in cash, and the rest is on account. That means the customers are going to pay me for the rest at a later period. The cost of the widgets purchased that I just sold to my customers, they were purchased in a previous period, was $4,000. So how would this look if I used an accrual basis system versus a cash basis system? So let's analyze this first one. I sold widgets to customers for $10,000. In an accrual basis system, that is my revenue. Make that 10,000. I'm going to format it here. I received $7,000 in cash, so under a cash basis system, I'm only going to record the cash I've received. I'm not going to record the rest of what the customers owe me. All right, and then it tells me here that the cost of the widgets that were purchased in a previous period was $4,000. So if I had paid for those widgets in that previous period, that $4,000 would have already been captured on my cash basis income statement at that time. So I'm not going to record that now because I'm not paying for them now. But on my accrual basis system, I pick up that $4,000 because not $40,000. In an accrual basis system, when I purchased that inventory, that would have been on my balance sheet recorded as an asset, an inventory asset. It stays on that balance sheet until I sell it to the customer. When I sell it to the customer, the cost of the items sold to the customer are removed from the balance sheet assets and recorded as a cost of sales expense on your income statement. Okay, so the second scenario, we purchased $4,000 of new widget inventory. We paid $1,000 in cash, and we owe the rest on account. Okay, under a cash basis system, remember we're only worried about cash changes hands. We paid $1,000 in cash, so we're going to record this $1,000 in widgets that we purchased. Sorry, I should have this pre-formatted. We're not going to worry about the rest that we owe later because we're not having cash go out right now for the other $3,000 for this new widget. Now, what happens on my accrual basis income statement? Well, if I'm purchasing $4,000 of inventory, that is not an income statement activity. That would be a balance sheet activity. I'm spending cash, which is an asset, to purchase inventory, which is another asset. So if you watch the previous videos about the accounting equation and keeping that accounting equation in balance, I'm basically swapping one asset for another. There's no activity that happens on my income statement. This will not get recorded to the income statement until I sell that inventory to a customer. All right, so next transaction, we paid $500 in wages for the month. That's a cash transaction that gets recorded on my cash statement. It is also an accrual transaction. This is an expense that we incurred, we owed for the month. We just happened to also pay it in that same month. Again, I'm just formatting these. All right, the next one, we received a $300 bill for utilities that will be paid in the next month. So no cash is changing hands right now. That does not affect my my cash on the cash basis accounting system, but I'm incurring that expense. I owe it right now. Even if I'm not paying it, I owe it. So that does become an entry on my accrual-based system for the expense I incurred. Okay, the last one. We received $2,000 from customers as deposits on order of new widgets to be sold to customers next month. I apologize, you can't see the rest of that wording, but if you look up here, you'll see these are going to be sold to the customers next month. So this is not a sales transaction on my accrual basis system because I have not yet earned any revenue. Just because the customer pays me money in advance, that is an unearned revenue. Unearned revenue is a liability on your balance sheet. So in my accrual basis accounting system, I would be recording this $2,000 deposit from my customers as a liability on the balance sheet, not on my income statement, because I still owe something to the customer. That liability represents something I owe. But on my cash basis system, I record this $2,000 as cash I've been paid. So I'm recording that now. So if I add up my revenues and subtract my expenses for both of these statements, let's see what the difference is going to be. So I have $9,000 in revenue there and $1,500 in expenses. So let's add up this plus this and subtract this one, subtract that one. There's my net income for the period. On this statement, I only have one revenue, which is this. So I'm going to add this and subtract this one, subtract this one, and subtract this one. Look at the difference in the net income that you're reporting on the cash basis versus the accrual basis system. Very interesting, right? The amount of income you're reporting also affects the amount of taxes that you're paying. But the accrual basis system is capturing the information more accurately, because if you also had access to the balance sheet, you would see the other information related to the items you're not seeing on the income statement that would be showing you the amount of money owed to you by your customers, the amount of money that you owe on expenses you haven't paid yet, any money you've received from customers that have not yet received their goods or services, etc. The cash basis system is not going to be as accurate because you're recording revenue that you have not yet earned, and you're not recording expenses that you owe. So there's a lot of information that's not made available to the user when they're looking at a cash basis accounting system. It could affect their decision making if they're wanting to invest in the company. So now let's take a look at what are adjusting entries. So remember, I previously mentioned using an accrual basis system requires you to have adjusting entries. So for instance, you might have an accrual that you have to record. You're accruing revenue. So this would be an example of earning interest on accounts receivable. So customers owe you money, excuse me, they haven't paid you yet, so you're charging them interest. So at the end of the period, you would have to make that record of that interest that you've earned, because it's not something you would capture in the normal day-to-day business operations from any evidentiary documents or something that you might have. So here I'm recording $500 in interest revenue. That would be an income statement item, and it's resulting in an increase to the accounts receivable balance. The $500 asset is increasing my assets by $500. for money that customers now owe me. And here's an example of where you might make a sale to a customer. They're not paying you yet. So you're accruing for that service revenue that you've earned because has not yet been captured in your accounting records. Excuse me. And for some accrued expenses, here's an example of where I owe my employees $5,000. I have to record that as an adjusting entry at the end of the period to make sure it gets captured that I owe that money. I have not yet paid my employees. And here's an example of where I owe interest. Perhaps I have a bill I haven't paid yet. Pardon me. And I owe that $400 in interest on that bill. All right, now remember I told you a second ago, accrual entries are entries where the activities happened, but payment has not yet happened. Deferrals, on the other hand, are where payment has happened, but the activity has not yet happened. So here's an example. If I pay a 1-year insurance policy in advance, I'm going to record the asset to prepaid insurance and reduce the cash at the time of the payment. Then every single month, as 1 month passes, that makes that insurance come due, I'm going to record a deferred expense. Or I'm sorry, I'm going to be moving that deferred expense. So this is the example of where it's recorded as a deferred expense. I'm sorry, I have these totally backwards. This is my deferred expense down here. I have them mislabeled. I apologize. Let me fix that really quick. These are flip-flopped. I've got them under the wrong items. This actually be my deferred expense. So I'm moving $1,000. I'm moving $1,000 of that prepaid insurance and record, because it's coming off of my balance sheet, out of my assets, and it's getting recorded on the income statement as insurance expense because now it is actually due. So that's when it becomes, it's no longer a deferred expense. It was deferred. I'm recording the adjusting entry to move it from the deferred. And the other example I was trying to show you that I flip-flopped here, you've received cash. So if you are the insurance company and you've received a cash payment for 1 year of insurance from your customer, you record the $12,000 cash you received on your balance sheet in your assets, but you also incur a $12,000 liability, which is unearned revenue, because you owe something to your customer. So you have not yet earned the money they've paid you. So at the end of your accounting period, you have to move the amount of that money that you've now earned. It comes out of your unearned revenue, out of your liabilities, and it gets recorded on the income statement as service revenue that you have earned. So I hope just looking at some examples of these is helpful. I apologize for my little goof there on getting those mixed up backwards, but hopefully that's not too confusing for you. But again, hopefully this is helpful. If you're one of my students, we'll be talking about this in class, so be sure